Of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap here on Friday, December 16th, 2022. I'm, of course, joined by my wonderful co-host, Jordan Youl from StoneCastle Investment Management. Thank you for joining me, Jordan.
Yeah, thanks for having me. It's good to be back.
So there's a few things that are exciting about today, Jordan. It is, of course, Quadruple Witching Day, which is when you're always with us. And it is the last episode of 2022. So it's been an amazing year. I've had such a great ride chatting with you and Bruce every week. I hope our viewers have gained something from it. We will be coming back in 2023 on, I believe, January 13th is going to be our first show of the year. We're going to break down a few things going on in the market today. We're going to talk about market overview. You're going to tell us in general what's going on. We're going to talk about the CPI data that came out. We knew about this last week. Bruce told us to watch out for us. You're going to tell us what came out and how it affected the markets. We're going to talk about Quadruple Witching Day because you're here. And then we're going to get into some CSE information about what our year looked like and what we're looking at going into 2023. So why don't we start off with the market overview? What happened?
Yeah, so this week in particular was extremely choppy. We saw an uptick in market volatility, and that really kind of coincides with what we'll touch on later with quadruple witching this afternoon. But I do have a longer term chart of just the S&P 500, just illustrating, how challenging it has been for investors this year. And I've annotated this chart just showing the drawdowns from the peaks to the lows, and then from the lows to the most recent highs. And effectively, we've been in this downtrend throughout 2022, but as you can see, based on the percentages, we've seen some pretty violent swings, anywhere between -14 to -21%, and then up 19, and most recently up just around 17% off the October lows. So there has been some opportunity to generate returns within the markets from a sector allocation perspective. However, that downtrend still remains intact. And what is concerning for equity investors is the fact that, the price of the S&P 500 failed to break through that declining downtrend. Now, we did poke our head through that 4,100 level, which I touched on several weeks ago. That was an objective upside target that we were watching. We did hit that 4,100 shortly after the CPI number that came out on Tuesday. But the concern is that we've seen very little follow through, and the price continues to decline effectively before or below that 4,100. So we're definitely not out of the woods yet. But if we look at the next chart, I think this is really kind of coinciding with, this year in particular. On the left-hand side is energy, and obviously energy has been the top performing sector in 2022. But furthermore, if you look a little bit closer, you see a lot of the defensives like consumer staples, utilities, and U.S. healthcare performing better than the cyclical and offensive sectors. So despite, the market making a big move off the October low, we continue to see the defensive sectors, really outperforming the torquier offensive or higher beta sectors in 2022. So the narrative might shift and change in 2023, but either way, we kind of remain in this cross-current environment that remains challenging for investors.
And when you showed that first chart, it did show that it's a solid 12 months that it's been on this downward cycle. But what we've had is opportunities throughout the year to have this discussion that there has still been opportunities within the market, right?
Absolutely, yeah. So the chart I referenced, the S&P 500, that goes back really from the all-time high in January until today. But the small caps have been in a more significant downtrend that really began in Q1 of last year. So the drawdown's been around 20 months. But internally, and we've touched on this over the last several weeks, but internally we are starting to see a rotation, a shift, especially with a pullback in the US dollar, which peaked a couple of months ago. That's created an opportunity in materials, right? So we've seen a lot of copper miners, base metals, precious metals, for example, really starting to perform and move up the ranks. So I think the takeaway here is, when I showed that sector rotation or what was performing year to date from a sector perspective, I don't necessarily believe that energy is going to be the top performer in 2023. I think we are going to see a rotation, out of energy into other areas that have been really beaten up where there's tremendous value. And that could be more tilted towards a risk on or more offensive tilt, because we've just gone through, around 18 to 20 months of defensive leadership, and we might start to see a rotation into, growthier areas of the benchmarks for 2023.
Well, that's promising. Okay, so we talked to Bruce last week. He said to watch out for CPI data to be coming through. Of course, CPI is what we use as a general gauge of how inflation is affecting us. What came out with the new data?
Yeah, so the year over year change, still remains elevated around 7.1%, but it's the rate of change or the trend that continues to decline. So the CPI number peaked in, I guess, July of this year, but as shown in the CPI chart, you can see that the rate of change or the trend continues to decline. Now, there's components that still remain elevated, whether it's housing costs or whatnot, because of the fact that we're in a rising rate environment. But we're also seeing commodity prices come down well off their highs as well, whether it's wheat or oil prices or what we're seeing at the gas station. So we want to see this trend continue. So we've had back-to-back CPI numbers that have come in below consensus, and the market initially reacted quite favorably as a result of the CPI number that was printed on Tuesday. But again, we were really watching what Jay Powell was going to say the following day, which was this past Wednesday, and what the FOMC decided in terms of increasing rates another 50 basis points.
Right. So essentially, we're still in it for a little bit, right?
We are, yeah. Again, inflation remains elevated, but the market's looking at that trend and rate of change. And if this continues to persist, we can expect inflation to continue to subside and come down. But the next chart with the FOMC, as a result of this, we still remain in this rising rate market environment. The next FOMC meeting is going to be in February, but as shown in this chart, you can see that the market is anticipating only 25 basis points for their upcoming February meeting. Now, this data will change and the implied probability will adjust as new data comes in. But effectively today, right now, the market's anticipating further rate hikes, but the 75 and 100 basis point hikes is not really on the table anymore. We're looking at 25 to 50, which is going to be a little bit more gradual and not as aggressive.
Well, and let's not forget that they were 75 to 100 basis points, but I think was there 7 or 8 of them in 2022?
Yeah, something like that. Yeah, like we had like the rate of change from, I always look at the 30-year U.S. fixed mortgage rate in the U.S., and it was 2.6% in November in 2021, and recently it was over 7%. So if you can imagine, on renewal or new home buyers coming into the market 12 months later, when you had an opportunity to, renew or get a mortgage at 2.6 or sub 3%, and now it's around 7%, that's significant, right? So I think that really kind of coincides with my comments in that some data within the CPI number is improving, but like the housing costs, for example, remain elevated. And, with tenants and renters, for example, what you lock into in terms of rent, that's not variable. Like that doesn't fluctuate month to month, right? So you're locking in for 12 months or 24 months. So you can see that component of the CPI number potentially change, but that could take a little bit more time.
Right, absolutely. Okay, we're going to talk about Quadruple Witching Day. This happened by accident that you ended up joining us on every Quadruple Witching Day. It is now mandated as part of our market recap mandate. Just to remind people, if you don't remember, Quadruple Witching Day is a simultaneous expiration of stock options, index futures, and index future option derivative contracts. This happens every quarter, right?
That's correct. Yeah. So today's a big day. And typically this is when really traders, they close their positions or roll over their positions into new contracts, et cetera. But the takeaway here is that a tremendous amount of volume and potential volatility picks up in the final hour of the trading day. which is, this afternoon. So that's what we're going to be really watching. And then just from a comparison basis, and just this has to do with timing with the CPMI number and the FOMC earlier this week, there was a lot of hedging activity going into those days. So I believe we're around $4 trillion of option activity will effectively expire, going into the close today. So we'll see what, the price action is going to look like, as we go into the final hour. But as I mentioned, this year in particular, we've seen a significant uptick in market volatility. And this is not just so much in 2022, but it's been, post-COVID. So I do have a chart of the implied volatility for, some common benchmarks such as, the S&P 500, NASDAQ, Russell, and emerging markets. And the takeaway here is that the black line, which represents the price, we've been in this 2-year trading range post-COVID, and that's where that big spike is. When the black line rose in March 2020, we were really in the depths of COVID, where we saw significant volatility because of all the uncertainty. But you can see that trading range on the right-hand side of that spike has been, in an elevated trading range for the last couple of years. Pre-COVID, the VIX used to range from anywhere between maybe 8 to maybe low 20s, but post-COVID, it's been like low 20s on the lower end to maybe mid to high 30s on the upper end. And, I think this is the environment that as investors, we need to become accustomed to or used to, is the fact that, we're going to continue to see an uptick in market volatility with all the cross currents that are taking place right now. And I think what a concern is the fact that the price is on that lower end of that trading range. So when that black line is rising, that is telling us that, the fear is building, and volatility could go either way, right? It could go up and down, but, we could expect to see some more bigger intraday moves within these benchmarks moving forward.
Absolutely. I think also, and maybe you can just comment on this, let's not forget that when the pandemic started, which would have been, I believe, March of 2020 is when we all kind of went into lockdown, the millions and millions and millions of retail trading accounts that opened up in the capital that flooded into the markets, that didn't necessarily all leave. So in these markets, there's potentially a lot more retail activity than there was prior. Do you think?
I think so. Yeah. Just work from home and whatnot, like the Robin Hood, theme, a lot of traders being able to trade from home and looking for alternative income options, if their work hours got reduced and whatnot. So, and that's really interesting. But to be honest, like looking at the fund flow, the retail investor is not invested right now. They have a tremendous amount of cash on hand, similar to levels to what we experienced during the March low in COVID. So there is a lot of cash that's still built up on the sidelines that needs to be deployed and put back into the work. And I think that's really a function of, all the pessimism in the markets and all the uncertainty. I spent a great deal of time this week talking to advisors, even other portfolio managers and do-it-yourself retail investors. And, the narrative really has remained unchanged. Everyone is still quite fearful and concerned about, earnings next year and, what the economic backdrop is telling us. And I think, looking at the US LEI index, which comes out next Thursday or on the 22nd, is going to be really, telling in terms of, what the prospects are moving forward for equity investors.
Well, listen, let's hope that we see that money come back in 2023 and some charts going the other way. We're going to talk about CSE, a year in review. Again, this is the last show of the year. Jordan, I believe you, Bruce, and myself, and sometimes James Black, we've now done, this is our third calendar year, I think, that we've done this. We will be doing it again next year and always adding to it and making it as good as possible. Hopefully it's been good for our viewers. I just wanted to talk, instead of CSE issuer news today, I wanted to talk about the CSE. We, in light of the markets and some of the charts that you showed, the CSE continues to grow very strongly. for the year, we've had 111 new issuers, or this is to the end of November. So not sure how many are going to trickle in December. That's a great number for us at the CSE. We continue to grow at a very fast pace. There were 738 financings from all of our issuers for a value of $2.071 billion. I'm so proud of our issuers. We have some amazing issuers out there. They really are entrepreneurs. They're out there, in these markets, raising capital, making transactions happen, getting investors to come in and put their skin in the game. So congratulations to all of our issuers who have worked very hard over this year. We have a brand new office that we're opening up in 2023 in Vancouver. It'll be much bigger. We have a bigger team since the pandemic. So we will be inviting everyone to come visit us at the new office when that opens. We've talked about this a lot. We have been working, our listings department and executive team have been working very hard on some upcoming new policies. These are pretty exciting for us because it will create a new senior tier to the CSE. We've been working alongside the regulators. I believe the team at the CSE has been working with them for several years now. So this is pretty exciting for us. It'll allow us to do just that much more and continue to grow and develop and gain new issuers and new market share in the capital market. So very excited about that. We traveled the globe. We finally got out of our houses and behind the screen or away from the screen. There was trips to Israel this year. There was trips to Australia. There was trips across the US and then of course across Canada. And we are very excited to be back out there next year and be doing more. So it's been a great year for the CSE. All in all, everyone's happy to be back out doing business again. I hope the market reflects all of this effort that everyone's been working on. I know that you at StoneCastle, you and Bruce have been just working like mad. I know that these markets aren't always easy for you guys, but you guys are on it with your clients, working your butts off, keeping everyone happy. Is there anything that you want to think about going into 2023?
Yeah, I'd like to see a lot of these indices like break out. Like beneath the surface, as I mentioned, we started to see some subtle signs of improvement. So I think really I'd just like to see some follow through. We've talked about this in length, but like in our asset leadership model where we're ranking different asset classes, from one being the strongest, five being the worst, what's really been a headwind or problematic for investors has been strength in the US dollar and rising yields. And both yields and the US dollar have pulled back. If that continues, that bodes well for equity investors moving forward. So internally, we're starting to see a shift in rotation that could really create an opportunity for investors to reallocate capital back into equities after really coming off of a challenging 2022, right? It's been equities, but also fixed income. So a lot of these investors with the 60-40 portfolios and what have you, a lot of their safe haven assets have been really beaten up this year. So what I'm seeing internally under the surface, that we get some follow through, that gets me quite excited for 2023.
Awesome. And going into next week, I know that we're not going to be talking again till January, but there's a few things as we're coming into the end of the year. What should we think about going into the end of 2022?
Yeah. So, as I just mentioned, like the US LEI index, the released through the conference board, that's released on the 22nd. And, that's a really good weight of the evidence indicator that has a lot of different economic data that gets factored into the index. And, unfortunately, this year we've seen that trend, continuing to decline. So if we start to see that reverse and turn up, that's great. That really bodes well for the economic backdrop moving forward. Because of this year, there's quite a significant shopping list for tax loss selling candidates, right? So, as long as we kind of remain in this distribution phase in the near term, that could potentially put some selling pressure on stocks between now and the 28th of December. But yeah, beyond, I guess next week and between the end of the year, I hope the Santa Claus rally shows up this year, right? We need it, right? So historically and from a seasonality perspective, usually the last several trading days of December going into January, the markets tend to perform quite well. So that's what we're hoping for as well.
The nice thing about next week is we don't have any official holidays next week. The holidays fall on the following. So let's hope for that Santa Claus rally. Listen, Jordan, I just have always enjoyed chatting with you. Thank you so much for such a great year with Market Recap and all of your contributions. I hope you and your family have a wonderful holiday and a happy new year, and we'll see you in 2023.
Sounds good. Looking forward to it, and same to you. Thanks.
Thank you, Jordan.